Back in 1929, the U.S. stock market tanked and kicked off the Great Depression. Stocks fell nearly 90% over 3 years, unemployment soared to 25%, and banks went belly up. People lost everything they had saved, and it took 25 years just to get back to where the market had been. Fast forward to 2008. The housing market crashed, stocks dropped over 50%, and millions of Canadians and Americans felt the pinch. Banks needed bailouts, retirement accounts were shredded, and recovery took 5 years. But 2025, this isn't your usual crash. Stocks, bonds, and real estate are all tanking at the same time. Financial historians are calling it the everything bubble. And unlike past crashes, there's literally nowhere to hide. Stick around, because I'm about to show you why this could make 1929 and 2008 look like a warm-up. And trust me, once you see the math, you'll understand why your money isn't safe sitting in any old account. The stock market bubble and concentration risk, the S&P 500, is trading at a price-to-earnings ratio of 28, almost double the historical norm of 15 to 17. That kind of overvaluation has only happened twice before, in 1929, right before the Great Depression, and in 1939-2000, right before the dot-com crash. Back then, markets tanked within months. Here's the kicker: for 2025, 7 megastocks, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, make up roughly 30% of the S&P 500. That's insane concentration. If these stocks nosedive, the whole market goes down with them. Nvidia alone trades at a PE over 65 and is worth more than Germany's entire stock market. Investors are betting big on AI hype, but history tells us that short-term valuations rarely match reality. And if you think that's wild, wait until I break down why housing and bonds are even worse. Stick tight, eh? Real estate and bonds. The double trouble. Housing prices in Canada and the U.S. are now roughly 50% above long-term historical trends, higher than the 2008 bubble at its peak. Meanwhile, commercial real estate is in free fall. Office buildings are sitting empty. Mortgages taken at 3% interest now need to be refinanced at 7 to 9%. Banks are staring down a tsunami of defaults. On top of that, bonds, the safe haven asset, aren't safe this time. The U.S. government is drowning in $36 trillion of debt, making bond yields spike if everyone tries to sell at once. This creates a doom loop. Higher interest rates make debt more expensive, which triggers more borrowing, which triggers higher rates. Rinse and repeat. Think you can just hide in your savings or 401k. Stick around, because this next part shows how your retirement could be toast if you're not ready. The human impact and what's coming. When the crash hits, we're not talking a small dip. Stocks could drop 65 to 80%, bonds 35 to 50%, and real estate 40 to 60%. Unemployment could exceed 15%, and recovery might take 10 to 20 years or more. Canadians and Americans alike could see retirement accounts evaporate. Millennials and Gen Z entering the workforce in 2026 may face zero job opportunities, suppressed wages, and decades of financial setbacks. The Fed can't fix this. They've run out of tools. The government can't bail everyone out. They're maxed on debt. This is the everything bubble in full swing. Your savings, your home, and your retirement are all at risk. But knowing the patterns is the first step to protecting yourself. So, are you going to sit there and hope it doesn't happen? Or are you going to get ahead before the storm hits? Stick around, I'll show you the moves that could save you, eh?